All right, so welcome everybody to the final episode of the four-part series of Brande's annual free tax seminars, and happy St. Patty's Day. So cheers. Nice little Irish cider for my day. I'm really excited about this. Cheers to everybody. Oh, how cute was that? I love it.
I just learned today that it's also St. Gertrude's Day, who's the patron saint of cats and people that love them.
Oh, it's like Double Lost Day.
Yeah.
That's so awesome. Well, happy St. Patty's Day, everybody. I started my day live streaming a Flogging Molly concert from Ireland at noon. So I may or may not have had to set my alarm clock for the first time in my life to wake up for a concert, which was fun because it's 8 o'clock in Ireland when they started, but it's noon in Arizona. So when I went to Ireland the first time and the last time, they had a beer that looked exactly like this. It used to be called Bulmers, and that's all I drank in Ireland was this Bulmer cider, and it was not imported here. And when they imported it here, they changed the name to Magners. And so this is the cider that I drank when I was in Ireland. So my fabulous boyfriend went out and found me some today. So cheers, everybody. Happy St. Patty's Day. I believe we'll start with some of my favorite things about the Irish people, which are their toasts and their limericks. And so I think for this first one, I am going to share with you this delightful Irish toast. Here's to you, and here's to me. I pray that friends will always be. But if by chance we disagree, the heck with you, and here's to me. Cheers! All right, a little fun to start us off. If you guys aren't drinkers, if you didn't bring your drinks today, you drink water, you cheers with us all you want. That's fine with me. Your coffee, your tea, whatever you have. All right. So getting started. I know a lot of you guys have been to all of these seminars, a number of these different seminars. So today we're going to go back to the basics. We're going to go back to the beginning. So we're kind of going to start as if you guys don't know a lot of the basic stuff. And the first thing that I want to start with is big news today. I'm not quite sure how I feel about it, but I think I'm pretty relieved that it looks like the IRS is extending the deadline to file until May 17th. So they've confirmed that this afternoon, which is really friendly considering that they usually start letting everyone file in mid-January. This year, they didn't let anyone start filing because of all the tax laws, which we talked about the new changes in episode 1. All the tax laws, like they were behind catching up themselves, plus they were rolling out new stimulus and all this stuff. So they didn't start the tax filing season until February 12th instead of mid-January this year. And so we're all of us, and then the unemployment thing where the first 10,200 is now not taxable that they just passed last Thursday. So now the IRS is like scrambling and all of us tax preparers are over here going, hey, so we have a month to like amend all these and go file all the people who have unemployment, which is, like 43 million people, like, excuse me, exactly. So the fact that they came out with this today, I'm just like, okay, cool, good, we can breathe, great. So that gives us a little bit more time to handle all our business. They just updated all the software. Today I got the release that we can go in and handle the exclusion for the 10,200. So now I have this whole list of people I've got to go back in and amend and fix and all this craziness. So, but it's going to be good. Like, it's going to be good. By my calculations, I think a lot of us are looking at maybe like $1,000 difference as far as how much extra we're going to get back. My mom can't get into the seminar. Let me get her the link. Just a second. Let me click this little thing here. So this is why you got to look when it's, even though you've already started, right, Barbara? Okay. She says it says the sale has ended. Oh, someone just let her in. Good. Oh, hey, Mom, you made it. Hey, Mom. Okay, yay.
Yeah, it gave me a hard time, but I get in.
Yeah, you tell him who's boss.
I did.
Okay, good.
So, you know.
Good. All right. Awesome. All right. Cool. So, so that's kind of the big news for today. Filing deadline extended to May 12th, so it gives us all a little bit more time to get our acts together. So, yay. Oh yeah. Cheers. Sorry. Cheers. We should certainly cheers to that, right, guys? Cheers. All righty. This is going to be a good seminar. I can tell already. All right. So just for some of you who are a little bit new, you do come in automatically muted on Zoom. So just hover your mouse around your screen. In the bottom left corner, you're going to find the unmute button. So when you are ready to speak, hit that unmute button. When you're not speaking, keep it on mute so we don't hear any background noises and cats letting them know what they think about my seminar and, you know, stuff like that. Nobody needs a critic, you know. So, so keep it on mute till you're ready to talk. You can leave your video on or turn it off, however you see fit. It's totally up to you. And if you're using a website browser for this, there is a little chat window over on the right-hand side. And if you pull up on the bottom, you can access the chat window if you want to comment over there, put links over there. There's also reactions if you want to put in emojis, and that's also where you can raise your hand as within the reactions. So if you want to raise your hand for something, let me know. I don't see everybody at the same time, so if you have your hand raised, I'm not calling on you, just like wait for a breath and interrupt me, all right? Most of you, I think, know about me, but just to sum up, I've been on the road for a long time, 23 years now. If you don't take 2020, does that bump me back to 22 years that I've been on the road? That's an exception. Let's push that aside. I manage Uncommon Adornments. I've been doing that for all of the 23 years. A few years ago, we launched Celtic Leatherworks. So I'm a co-owner of that one. I'm also the founder and president for RCEF, which is the Renaissance Catastrophic Emergency Foundation. Thanks to them and to Life's a Faire for letting us be here today and put this on. So, so thanks for all that. I've also been a registered tax preparer for over 15 years. Last year, I did about 200 tax returns, mostly in the community. Some of my mom's retiree friends as well, but mostly in the community. I do all kinds of different taxes, individuals, independent contractors, business owners, artists, entertainers. I am registered with the IRS and I have a P10 number. So I do know what I'm talking about, even though I'm still, you know, I'm one of us. I do this in order to help kind of demystify taxes. I know that most people find taxes extremely scary. And I think that the more we talk about it, the more we learn and understand, the more the less scary it becomes because we understand more about what's going on. I feel like knowledge is power, and we have to learn how to play the game and how to work within the system. So our tax picture is generally more complicated than most people's. That is a fact. But it's just a matter of learning how to put the puzzle together. So I like to teach that and make sure that everybody, you know, understands all the ins and outs of taxes. So we're going to put up a super quick couple of, Andrew, we didn't talk about a couple of polls, did we? So, hey, Lindsay, I see you're here. Let's just do one of these things where everybody turns their video off for a hot second, or turns their video on, I mean, so I can see your faces. And let's just do a show of hands real quick, okay? So who on here is a business owner? Let's raise your hand. If you take the down near where the mute and unmute button is in the bottom left corner, there's a video button that should have a slash across it. If you click it, it'll get rid of the slash, okay? So let's try our hands again. So business owners, raising your hands. All right, business owners, business owners. Okay, how about people who are workers and earn W-2s for any of their jobs? I should have raised my hand for the last one too. Business owner for that one. Yeah, we got a little bit of that, a little bit of that. Okay, how about people who are workers and get 1099s or cash? Any of those peeps? Okay. All right, cool. And then how about people who are like all of the above? Yeah. mixed income earners, they call us. We have like a new catchphrase these days. We're so trendy. And how about retirees? There's one. Okay. All right, cool. Okay. So just gonna go right into what we're gonna be doing today. All right. So today is gonna be our basics, and let me get our little syllabus showing on your screen here. All right. So today can you guys see the week 4 syllabus? Okay, great. So today we're going to be talking about some of the basics of taxes, since that can sometimes be a little boring and a little overwhelming. And it's St. Patty's Day, we're making it the drinking game edition. So cheers. It's going to be fun. All right. So when and why you should file. When you're filing with W-2s, 1099s, or cash, taxes while you travel for work, which is what I think most of us do, that's where we get most of our write-offs. That's super important. Per diem, what is it and why does it rock? What expenses are a no-no? Working multiple jobs and owning your own business, how to split all that stuff up. The pandemic effects on our taxes, lots of changes this year for that. What kind of expenses we can write off, audit defense. I think we may take a few steps during that subject, and a whole lot more. So that's what we're going to be covering today. And let me get back in over here. All right. Okay, quick rundown on the new COVID relief bill that was signed into law last Thursday. That rocks. So cheers. We have a $1,400 stimulus per person. A lot of us got these today. We were taking a little non-scientific poll before we started all this. It looks like about half of us maybe have gotten them today. If you've gotten them direct deposit in the past, you're probably going to get this one direct deposit. Some people got the first one direct deposit, and then they sent those debit cards for the second one. So they're a little loosey-goosey on how they're doing it. If you got checks by mail or debit cards by mail in the past, that's how you're going to get this one too. So obviously that's going to take a little bit longer to get to everybody. So keep checking those accounts, and hopefully we'll start getting more stimulus payments out to everybody soon. It was a nice thing to wake up to, or actually, I guess I was technically still awake when it happened last night. So, so it was pretty fabulous. If you are a single person, you make under $75,000 or $150,000 if you're married, that's who's going to get that $1,400. Above that, it's going to start to slowly phase out and then go away. Unemployment benefits have been extended to September 6th with an extra $300 per week from the federal government on top of our state portion already. A lot of us are sort of in flux with that right now, where our accounts are kind of frozen. Most states are telling us to continue to do our weekly claims. Some states are asking us to reapply. With the last extension in Arizona, at least, we had to go in and answer just a couple questions, just basically saying, are you still unemployed because of COVID and blah, blah, blah. And then we didn't even miss a payment. This time, we definitely are missing this week's payment. So I don't know how delayed that's going to be. But that's going to be another one of those things where every state plays by their own rules. So we'll see when that all starts showing up. But we're kind of collecting that data. We as RCEF have probably helped, 400 people through the unemployment process through this whole thing. So like I said, every state handles it differently. So I always tell people, please let us know how it's going for you, and if you got it started back up, how long it took, what you had to do, did you have to do a new application, or was it automatic, that sort of thing. So keep us posted on that. The big doozy is that the first $10,200 of unemployment is now non-taxable income for 2020. If you make under $150,000, that is. So that's a real big deal. That is causing us to have to go amend a bunch of returns because they just passed it. And stuff like that. Amending a past return, if you've already turned it in, is on hold right now. The IRS is asking us not to amend anything right this second. They have not given us any sort of directive even on how to go about doing that. So those are kind of on pause. And today, I got the update from the IRS with in the software package that I use to prepare everybody's taxes, where I can actually now, all the people who I didn't file yet, I can go put in the new exclusion. So that's gonna be really exciting to see everybody's refunds like skyrocket up when I put in that exclusion. So I'm really excited to give that news to lots of people this week. It's been a bummer to let people know when they didn't have taxes withheld from their unemployment that they owe all this money. So it's nice that they've done this. And for people who did have taxes withheld, it just means a bigger refund. So that's really exciting. The child tax credit was raised from $3,000 to $3,600 for 2021, and they're setting up some program for parents to get paid monthly per child, which is not ready yet. More details to come on that, but that's going to be kind of interesting. I don't know what that means for the child tax credit once we get into your tax return, because I think it's basically a down payment, basically a prepayment of that credit. So I think a lot of parents aren't going to get these huge refunds that they're used to. So hopefully people understand that's not on top of, that that's instead of, is what I'm gathering. We'll see how details come on that one. They don't usually change the tax law during the season, but it's a pandemic, so I guess that's what we're doing. There is more stuff in this bill for food assistance programs, housing aid, health insurance subsidies, and a whole bunch more stuff that they haven't released fully yet. So be on the lookout for that sort of stuff if you, fall into categories of people who, get your insurance through the ACA and get a subsidy. They're going to be like making higher subsidies for people under a certain income level and stuff like that. So that's kind of more stuff to look forward to. So that's kind of cool. As they release new things, you guys know that we'll always be posting them. So our RC will always post it. I'll always share it to all the groups and everything. So when there's big news out, you'll see it coming from us. All right. So let's have a conversation about why you should file. So technically any single person who's under 65 is only required to file if you have income over the federal standard deduction of $12,400, but that's for a W-2 employee or like a retiree who's over 65, who's on Social Security. On a W-2, you have taxes withheld already. So they don't require you to file under $12,400 because that's a federal standard deduction. And you've already had taxes withheld for the most part, usually. And so they don't care if you don't file a tax return, because if you do, you probably are owed a refund. So they don't really force you to do that. But how many of you know that if you're self-employed, you must file any income over $400? So let me say that again. If you're self-employed, if you get cash or 1099 income, you're required to file a tax return if you earn more than $400. That is a big, big, big miscommunication, especially in our community. I hear all the time, I haven't filed in previous years because I didn't make enough to file. And I go, what do you think is enough? Because a lot of people have this $12,000 figure in their head, but that is not for people who have not been withheld on. So make sure if you can spread that word around. That is super important. We've seen more important than any time in our lives in 2020. It's been very important to do your taxes, as stimulus and unemployment and everything is tied to taxes. So that's super important to make sure that people understand that income threshold. But even if you technically don't have to, there are lots of reasons that you should file your taxes, like I said, as we've seen in 2020. We also know, for those of us who have spent weeks and months applying for small business loans and grants, that you can't get any of that without a most recent tax return. We talked a little bit last week about the PPP and how they just opened that up to small businesses under 20, sole proprietors and independent contractors. I'm sorry, small businesses under 20 employees. I didn't finish my sentence. Independent contractors and sole proprietors. So they just opened that up recently, but it requires a 2019 or a 2020 tax return. The income that we're filing for this grant for is for lost wages or lost income. So it's a grant that you don't have to repay. and they just changed the law that says that it's going off of our gross income and not our net. Up until March 3rd, it was going by our net, which you all know after we get all our expenses in there and our assets and depreciation and our vehicles and all that, our net is usually pretty minor. So a lot of us didn't even bother applying for the PPP, but now that they've changed it to gross, that's a whole different subject. So if you guys have not yet gone and applied for that, if you file your income taxes on a Schedule C, you're eligible now, no matter who you are or how you earn your income. So if you have questions about that and want to talk to me about PPP after that, after this call, send me a PM and I'll walk you through it. So, oh good. Andrea is saying the arts community here in Fort Wayne, Indiana, has no concept in that. So I've been trying to get the word out. Good. Yeah. I mean, there's word of mouth is really how it's gotten around our community too. I've had people that I don't even know who are PMing me and they're like, I know we don't know each other, but so-and-so said to message you and you'd help me, fill this out. And it's like, yes, okay, let's do the thing. So it's good. Word is clearly getting around, and that's good because I think this is going to be a nice lifesaver for a lot of people right now, including myself. So yay. Also, more reasons why you should file proof of income, as we talked about, disability and Social Security and Medicare. I talked about this, I think, on week 1, but back when I was heading up the advocacy program for rescue for many years, we learned this, excuse me, kind of the hard way. A lot of people think that Social Security comes from when you retire, but Social Security also comes from if you're disabled. If you are in a car accident tomorrow and you're 25 years old, they may deem you disabled, but if you have not paid into the system, they won't give you disability, and therefore they won't give you Social Security, even though you can't work and earn a living because you're permanently disabled, and they won't give you Medicare to take care of your chronic condition because, again, you didn't pay into the system. These aren't entitlements. We pay into this. When you have a W-2, when you have income on a W-2, you're withholding your FICA, all that stuff they take out of your paycheck, that pays for Social Security, for Medicare, for disability, for all of that sort of stuff. It also pays your unemployment insurance, which is why people like me who were W-2'd before 2020, we got our unemployment real quick because our employers have been paying unemployment insurance on us for a long time. So if you're W-2'd, you're already paying into the system. But if you're self-employed or you earn cash or a 1099, you pay into the system by doing your tax return. When they assess self-employment tax, after you do your Schedule C, which is where you report all your income and deductions and stuff, they assess self-employment tax. That's how you're paying into the system. So if you don't do your taxes, you're not paying into Social Security, you're not paying into Medicare. Social Security is an average of the last 7 years income of your working life. If that's retirement, then yeah, that's like later, in your life. But if you somehow, God forbid, get some illness like a cancer or you're in a car accident, it's the last 7 years of your working life. So even as a youngster, if you're not filing taxes, it just hurts you. So this is a reason why you want to make sure that you're filing your tax returns every single year. Even if your net income doesn't show a whole heck of a lot, you're still in the system, you're still paying your taxes. It keeps you able to get these sort of benefits when we need them. And we've seen in 2020 that these government benefits are all out there to try to help us, and here we are benefiting from them this year. So, so don't short yourself when you get into retirement, or if anything, bad ever happens. So just keep that in mind. Don't be scared, and please, please, please tell your friends who don't like to file taxes, people who work for you, whatever. Don't be scared. I hear all the time, I've never filed because people told me I shouldn't file because I'm going to owe so much money. That just pisses me off like crazy. Because usually people who say that don't know shit about shit, frankly. They don't know how to do tax returns, so they don't understand them. They probably don't do them themselves because they're also misinformed. So I hate when people come to me and say that sort of thing. And I try to explain to everybody, people who have businesses, and especially people who travel for a living, we have a ton of expenses. So long as you're keeping track of all your expenses, you're not going to owe an arm and a leg until your business is rocking and you're making a good bit of money. So I don't think that people need to be freaking out about this. And I will say that in 2020, or doing the 2020 tax return is the easiest place to start if people have not been doing their taxes. We've got unemployment on there. We've got stimulus we're able to claim if you didn't get it as a refund. So there's a lot of stuff in there, not to mention like we didn't make much money. We don't have a lot of expenses to document. So it's got to be the quickest that it took me to get my taxes ready to do. I don't know about you guys, but so all those things combined, like this is the year to start. So even if you're way behind, even if you've never filed taxes before, which there are still people out there who fall in that category, now's a great time to start. And if you start with 2020 and they want to see some back years, maybe a couple that you missed, maybe you'd never done any, they're going to send you a letter. They're going to ask you to see your 2018 tax return, and then you call up your tax preparer or you do them yourself and you go, hey, I need to do 2017. And you go, okay, cool. And then you send it. So no, it's really not that big of a deal. Unless you owe them like a crap ton of money, you're not going to get a bunch of fines and fees and penalties or anything. That's all assessed on how much taxes you owe. So, you know, if you only owe them $100, what are taxes and penalties on $100? Like a couple of dollars. No big deal. It's not worth the headache. So just get right now. You know, start now is my message to all of that. All right, so we're going to start running through Tax Basics 101. And before we do that, cheers. All right. Okay. So first things first, standard deduction. We talked about that a little bit ago. Everybody gets a chance to take the standard deduction. You also get the option to do itemized deductions. When you're a sole proprietor, independent contractor, you earn cash, I get 1099s, all of the itemized deductions happen on your Schedule C. So that's where you're going to put all of your income, and that's also where all your deductions come from. If your total of all your itemized deductions on your Schedule C comes out to be more than the standard deduction, which is currently at $12,400, then you go the itemized deductions route. The Schedule C is super important because that's the form that proves that you're a business. So even if you earn cash or you're a 1099 worker and you work for someone else, you are still a small business owner. You're still a sole proprietor. You're still in business for yourself. You file a Schedule C just like any other sole proprietor booth owner who's out there on the road, so long as they are not a partnership or an S corp or something. So you can do married filing jointly. You can do married filing separately. Now, just a word of warning to those of you who have those options. In 2018, when they changed a whole bunch of tax laws, they made it really, really not worth filing separately. They've taken away your ability to get earned income credit. They've taken away a bunch of tax credits, rebates, all kinds of stuff that they say if you don't file together, you're not going to get. The point of that is because sometimes one of the spouses is hiding income and they never file their tax return, and the government does not want that. So they're basically giving married people an incentive to file together. So that's what all those credits are about. If you have a spouse who has massive debt, who owes, they take their refund every year to cover, you know, a defaulted student loan or something like that. There are lots of reasons why some people don't want to file together. There are things called innocent spouse forms that you can fill out on your tax return that basically says, you know, his debt is his debt, my debt is my debt, and I don't want to be responsible for his. And so that's just a form that you can put on your taxes. So that's something that you can do that still keeps you legally, you know, getting all your credits and stuff like that, but makes you not strapped to somebody else's mistake. So keep that in mind. Most of us out here, I think on the road in particular, we're really kind of quite the entrepreneurial group of humans. Most of us have 2, 3, 4 different businesses, different jobs, different things that we do. You know, some people consider something a little side hustle. Some people do stuff during the week from home. Some people do stuff on the weekend. That's different depending on what show they're at. Some people run their own business at one show. They're a contracted musician in a different show. So there's all kinds of different rules out here when it comes to kind of breaking apart those businesses on your tax returns. We're going to talk about that a little bit more in a second. But when I talk about businesses or small businesses, I am talking about booth owners, obviously, but people who are paid cash, 1099s, you're all business owners, you're independent, even independent contractors. You're all what are called pass-through entities. So that's an important term to remember. A pass-through entity, if you are any of those people that I just listed, you do all of your income and your expenses on your Schedule C, and then it passes through onto your Schedule 1, which reports all of your income, and then that passes through to your 1040. So that's why they call us pass-through entities. There are certain tax credits and things that only apply to pass-through entities, which is really kind of cool. But if you're an S corp or something like that, you know, it's a little bit different because you're going to do a business return and then you're going to do your own personal Schedule C. But there's all kinds of things, like in 2018, they passed the new law where for a pass-through entity, your qualified business deduction meant that the first 20% of your taxes your income after expenses are non-taxable. That's new. We've only had that for a few years. So before that, everything, your net income, as they call it, your gross income's your total sales or your total income earned, all your expenses, and then after all your expenses becomes your net income. The QBI deduction says that 20% of that net income is not taxable. So that's really cool, and that's only a special exclusion for pass-through entities. So that was a pretty nice thing that we got a couple years ago. Does anybody have any questions on anything that I've mentioned so far? We're going to go into W-2s versus 1099s in a second. Raise your hand or pop it into the chat if you have questions for me so far. Okay. All right, I'm going to keep going then. All right. 1099 versus W-2. So we've always filed miscellaneous income on a 1099, and it was a 1099 MISC for miscellaneous. Box 7 is where we always used to file our non-employee compensation. And now we file it on a 1099 NEC for non-employee compensation. It's the only thing that's on that form now, and that's where you're going to pay anyone who worked for you and earned $600 or over in a calendar year. If they earned less than that, you are not required to issue a 1099. But if they earn more than that, then legally you're supposed to be issuing them at least a 1099. This is for self-employment. This is independent contractor income. Social Security and Medicare, again, are paid through your tax return. So there's no taxes that are deducted by the employer. There's no unemployment that's paid on you. There's no payroll. It certainly is the simpler way to do it. A lot of people still don't even do 1099s for their workers. Again, in 2020, we have really seen how having a piece of paper is super important. So just consider, if you are not 1099ing your people, that you at least begin to do that soon. I think it's just a kind thing to do now. And if people freak out by the fact that you're going to start issuing a 1099 to them, usually that's because they don't quite understand the system and they think they're going to get in trouble. And again, I will say that if you want to give them my contact info, I will talk to them about why it's not the end of the world if they get 1099'd. But just make sure that you are warning people ahead of time before the season starts, while you're having a conversation about hiring them, before the show even starts, before they work 1 hour, before they travel all that way, for the love of God. Have the conversation with them and let them know that you're going to start 1099ing them, that you're going to get their social security number, and they're going to get a form at the end of the year. If they refuse, then you're just going to have to make the decision as to whether or not a $550 failure to file fine from the IRS is worth having them. And that's just a fact of a matter. The other side of things is a W-2. If you get a W-2 from an employer, that makes you technically an employee. Taxes are withheld. You pay half your Social Security and Medicare, and your employer pays the other half. So it's a matched donation to all of your taxes and retirement things. So that's kind of cool, kind of nice. On the employer side, you now have to pay for workers' comp in every single state you do. You now have to pay for unemployment insurance in every single state you do. On every single employee that you have to run payroll and have some sort of system of doing deposits or writing checks, but having pay stubs and things like that. It's a lot more complicated, that's for sure. We talked last week in the business owners seminar a lot more in depth about when you should be filing one or the other and what the distinction is. So I'm not going to cover that here. All of the previous seminar videos are on the Life's a Faire YouTube channel. So you can go back and watch it, but we specifically talk about 1099 versus W-2 in last week's business owner week 3 seminar. If you don't get a 1099, so if you worked for somebody, maybe they gave you cash, maybe they gave you a check, whatever means of paying you they did. If you didn't get a 1099, number one, you are legally required to claim all of your income, form or no form. So you are required to claim your cash. If, again, you didn't make $600, which requires the employer to give you a form, you're still required to claim that $550 or whatever it was on your tax return. Do a lot of people do that? No. Should they? Yeah. Here's why. Again, your Social Security is based on the last 7 years of your working life's income, right? So if you are an entertainer and you make half your money in cash, if you're a business owner and you only report to the government what you make through the square, God forbid, but please, don't do that. But but I see it all the time. Like, they're not stupid. They know you're not turning down cash. Like, stop that. But if you're making cash and you're hiding it, you're only hurting yourself, because in the end, when it comes to Social Security, you're only getting what you report to the government. You get a percentage of that in Social Security. So you're literally just shooting yourself in the foot. When it came to unemployment, when we're all on unemployment in 2020, they gave you the minimum amount that they were legally able to give you per week, unless you could prove that you made more than X amount of money. Every state's different what that threshold was. But if you could prove that you made more than that amount of money, then you got more money per week. I can't tell you how many people came to me and said, oh, damn, I didn't report my cash income on my tax return, and so I'm getting half what I would normally get if I would have filed the correct amount of money. And I'm over here like, yeah, buddy, that's a crappy one. But you did it to yourself, and now cut that out. But it's really important to make sure that you're claiming all of your cash, okay? If you get, this is the other question I get all the time. Independent contractors are often scared because their employers know that they're supposed to be giving a 1099 and they're not. And so a lot of people don't want to tell me their cash income because they're concerned they're going to get their employer in trouble, especially if this is someone that they work for over and over and over at multiple festivals or multiple years. And just so you guys know, logistically, when you do a tax return on your Schedule C, if you have cash income, there's literally just a field that says like gross income. You can put a number in there and that's it. There's literally no place to put a business owner's name in there. So doing a tax return cannot get that business owner in trouble. Now, if you got audited and then they said, who paid you this? And then you were forced to tell them, now that business owner could get a fine. Are they really auditing most people who are out there earning cash and making $18,000 or less a year? Not really. It's not really a thing. So I don't think you're going to get anybody in trouble by doing that. It's just very important to make sure that you're reporting all the cash, okay? Does anybody have any questions on that subject before we move on? I'm looking for unmuting and hands raised, and I don't see any. Okay, moving on. Okay. Yes.
Is it pointless to go back and create 1099s for past years for my independent contractor employees?
I don't think, I wouldn't call it pointless. I don't know if it's necessary at this point. So they give you fines based on how late your 1099s are. And at some point when it becomes like a year late, it's like the maximum penalty of failure to file, which is $550. So if you're talking about for 2020, where the 1099s were due February 1st of 2021, you're only you're like a month behind. Like, yes, I would go back and do those. If you're talking about 2019, 2018, no. You just like, please don't catch me. That's like where you are at that point. But for 2020, you can definitely, I have some to do for somebody tonight. So you can definitely go back and do that right now. And I do have some people who have never been on unemployment, who have not gotten it this whole time because they had no proof of income. So we have some employers who are going back and issuing them 1099s now so that they can get on unemployment because that's their only proof of income. So, so yeah, that's something to consider.
Thank you.
You're welcome. It's good to see your face.
Same, so good.
Okay. 1099s are super easy to do, you guys. It's like name, address, social, and a dollar amount. I personally charge $10 per person to issue 1099s. That includes e-file, because more than anything, I just want people to start getting on record and making it happen. You can also get those forms at Staples or Office Max or order it from the IRS and fill it out by pen and mail it in. Like, it's just super easy. So just keep that in mind and let's make that happen. So we're going to move on to dividing up write-offs between businesses and self-employment. So if this includes you, cheers to having multiple businesses, you go-getter. All right. Yay, St. Patty's Day tax seminars. I love it. All right. So as we talked about before, Schedule C is where most of us are going to be reporting our income and expenses. If you have multiple businesses that you use, like we talked about before, maybe you own your own jewelry business, where you have you're contracted at some festivals, you're a musician at another festival, and you work for someone managing a booth at yet another festival, okay? You're looking at 3 separate Schedule Cs. And the reason why this is important is because, just like in the medical field, the procedure that the doctor does has to match your diagnosis, or insurance won't pay on it. It's just like that. So your expenses have to match your business profession title. So you wouldn't be able to expense off guitar strings for your jewelry business. That doesn't make any sense. So you want to make sure when you're divvying up and thinking about your businesses that you think about what the expense belongs to. And if you happen to have expenses that could work for all of them, like costuming, for instance, you allocate that expense toward the business with the most income. So if you have multiple businesses, you can have multiple folders in a filing cabinet, multiple manila envelopes, like I've talked about in previous seminars. I just shove everything in a manila envelope myself. So you can have multiple manila envelopes. If you're a spreadsheeter, you can have multiple tabs on your spreadsheet where you're documenting the expenses for each of your businesses. So make sure you're keeping those things separate. Yeah, I see Elise's hand. Elise has a question. Go.
Okay, so Arizona and Colorado both make me file my sales tax together for my mask and my jewelry business. So I've put all of those receipts together because I'm putting the sales tax together. That'd probably be an exception, but I just figured I'd mention that.
I don't think that that's like a huge deal, because when you're filing all your businesses together, if one is kind of like, if one's at a negative and one's at a positive, they kind of offset each other, you know? So they wouldn't take away that deduction because you allocated it to the wrong business. You would still get it. When you allocate it to a business that makes no sense, now they're going to start wanting to look at everything and take away deductions and stuff. If I were you on your side, even though you know that you paid them together, you should be able to do the math yourself and say, I made X amount at this show for this business and X amount for this business times 8.25% tax. So then I can separate and do the math. That's how I would do it. Does that make sense? So like you can do the math on the back end, even though you paid it together.
Okay, so you'd recommend breaking it down into multiple Schedule Cs.
You know I always want to do that.
Okay.
Yeah, I think that's a good idea. And the other side of things too, and I don't know if you guys caught all this with the PPP and with the EIDLs and things like that, you can file separate times for each EIN number that you have. So if each of your businesses has separate EIN numbers, which by the way, EIN means employer identification number. It actually doesn't mean you have to have any employees. It just means you're identified with the federal government as a business and you have a number like your social security number that matches your business. You can do it online at irs.gov for free. Don't go use any of those stupid pay systems that you'll find if you just Google it. Like you can do it for free online. It takes 5 seconds and then you have an EIN number. And then that means that you can actually apply for separate PPPs and EIDLs under your different business EIN numbers. So that's kind of a cool thing that we found out, like going through all this pandemic stuff. So if you have a business and you don't have an EIN number, I highly recommend you go get one. And that'll help you also differentiate all of your income, your sales tax, like all that stuff, because now each one has its own number associated with it. Okay, just going through and making sure that I don't have any hands raised. Okay. All right, so we talked about all that. I was talking about before in some of the seminars we've done about saving everything. I'm going to tell you the scenario again that a very kind IRS auditor once gave me about how receipts are king. Bank statements, credit card statements, things like that are great, but they're only supplemental. Itemized receipts is where it's all at. An IRS auditor told me once that if you show me a bank statement and you bought $75 at 7-Eleven, I don't know if that's $75 worth of fuel or $75 worth of Slurpees. And that is a quote. The itemized receipt proves that it's deductible fuel for your business. If you're just $75 worth of Slurpees at the 7-Eleven on your road trip, that's probably going to get questioned by the IRS about your Slurpee problem. Maybe suggest some therapy or some sort of psychiatric help for your Slurpee issues. But itemized receipts are everything. It doesn't matter if you keep a piece of paper. Like I have always said, I just shove it in a manila envelope that says 2020 on the front of it. And at the end of the year, I sit down with my own tax organizer, has all the different deduction categories. I sit on the floor and I make stacks of receipts and add them all up. That's my system, but I have a system, you know? If you do digital receipts, which I think 90% of my receipts these days are digital receipts, you can do that too. There are all these different apps out there these days that are mileage trackers, receipt trackers. We've talked about those on these previous webinars, but people love to use QuickBooks Self-Employed if you're a QuickBooks person. It is a receipt tracker and a mile tracker. It's a subscription-based thing, but it integrates in with your computer's QuickBooks. So if you're into that, then cool. There's Stride and Everlance, which are both free programs. And then Adrielle, tell me the name of the one you love again. No, she refuses. She's coming. She's working on it. Hold on. Mute button. You can do this. I believe in you. Oh, she typed it. Good. Hurdler. This is why I can't remember it. It's not even spelled right. These millennials with missing vowels and stuff, whatever. Spelled Hurdlr. Hurdler, yeah?
Yeah, that's why I typed it, because I was like, well, it's spelled weird.
Yeah.
I think they're relatively new. I've had good luck with them being very interactive on customer service, which I like. Yeah. I'm still playing with a lot of different ones, but
yeah,
that one seems to be good.
Yeah, Andrea is saying Mile IQ also. I used that one a long time ago when it was one of the very few that did this kind of thing. But what's cool is not only do you keep it in your phone as an app and it tracks your mileage, which is real neat. We talked about Everlance being like the Tinder of mile tracker apps, because at the end of the day, they show you a little box with like Google Maps of all your trips, and you literally like swipe right for personal and swipe left for business, which is kind of cool. But at the end of the day, all these apps will ask you, is this business, is it personal? And then at the end of the year, they give you this PDF with all your miles that you traveled for the whole year, how much of it was business, how much of it was personal. You don't have to do any math or figuring. It's brilliant. I love it. The other side of things is they're all receipt keepers these days too. So if you go into a store and you get a paper receipt, you literally take the app, open it, take a photo of the receipt, you tell it which category to classify it into. So there'll be some general categories for business that'll be in there, like office expenses or supplies or whatever, but you can also create your own categories like booth fees if you want to, or garb, or whatever you want to put it in. So you can automatically upload it to an app and get rid of that piece of paper. If you travel like a lot of us, you live in an RV or you travel from place to place in a small car, like not carrying around a gazillion receipts is really kind of cool. And with a digital app, you've got a backup. So if anything ever happens to your paper receipts, they go up in flames, they get stolen, you traded in your vehicle and forgot to get your receipts out, and there's more than one time I've heard that. You've got a digital backup. So if you ever get audited, all you do is make photocopies of physical receipts, or you print out your gazillion digital receipts. You're just sending them copies, so they have no way of knowing if it's a paper receipt or if it's a digital receipt. So that's a good idea, and it backs up to the cloud. And so even if something happens to your phone and you drop it in a hot tub, not that that's ever happened to me, or something like that, then you've got a digital backup in the app. And I think that always having a backup of everything is just really smart. And so if you're, so just make sure you're keeping everything. If you have any question as to whether or not something is expensible, you can drop me a quick line and just say, hey, I'm thinking about buying this thing. Can I write that off? And 9 times out of 10, I'm going to be like, yeah, you can write that off. So just save everything. And at the end of the year, you find a category where it goes, and then you're good to go. The other thing to keep in mind is when we're going to talk a little bit later about state income, and allocating your business income, keeping track of what you earn in each state and why that's important and stuff. But the other thing to keep in mind is that your income needs to be separated out by state, but your expenses do not. Your expenses also don't need to be separated by month. Like people have those month organizers and they'll send me a monthly breakdown all the time of their expenses. That's not how this works. You don't need a monthly thing. You need just a grand total. And the only thing you need to separate out is your income by state. That's it. So keep that in mind as you're tackling all of this and organizing and everything. All right, so we're gonna go into a category about expenses. Before we go into that, does anybody have any questions about what we just talked about? I'm looking. Lindsay has her hand raised. Go ahead, Lindsay.
This may not have to do necessarily with receipts, but I was thinking of it because of receipts. I know that, is it true, I should ask this, is it true that charitable contributions are now counted separately outside of the standard deduction? So you can do those in addition to the standard deduction?
Yes, ma'am.
Do you need then the receipts for that? Because I didn't get any receipts from the rescue or from the Renaissance help, like that. I figure what is it called? RCEAF
organization, RC?
Yeah.
Did you donate an item or did you donate money?
Donated money.
Okay, so you should have gotten an email receipt from someone who's on this call right now. And if you send me a message afterward, I'll look up the donation. If you make a charitable donation, I'm gonna scratch what I just said. When you make a charitable donation of an item, that's when Nancy, I'll call her out right now. That's when Nancy is gonna send you an email with a receipt in it. But when you make a monetary donation, that actually comes from the platform you used. So Square or Zelle or something like that.
Okay, so I can use those. So because I keep everything in PayPal, because that's usually how I pay for. I'm talking about the auction items, because the auction items count as a donation to the foundation. So I just want to make sure that all of the auction items that I paid for, I can also use as deductions, and can send you the PayPal list.
Yes, absolutely. And the PayPal or Square or whomever you donate through will say who you donated to, and if they're 501c3, it usually will say donation, but if it's for an item, it may say payment, but it'll show that it's to a charity. So that's absolutely all you need in order to prove those things. If you donate to Habitat for Humanity or Rescue or any of those things, it's gonna be the same thing. Go to the platform in which you donated. Well, so what Lindsay was talking about with this charitable donation is in 2018, they gutted Schedule A, which is where charitable donations used to be. And it basically made it to where you had to get above $12,400 in all the things that are on Schedule A, which is mortgage, charitable donations, medical, a couple of other things. If you don't have those things, you don't get any charitable donations. I don't have mortgage, I don't have medical stuff really. So I just have basically been donating out of the goodness of my heart for a few years now. But this year, starting on the 2020 tax return, because of the pandemic, charities were hit so hard. So they put a deduction in where everybody gets a $300 charitable deduction off the top, as they call it. So no matter if you have itemized deductions or you take the standard deduction, you get a $300 charitable deduction up to $300 this year in 2020. So so that's kind of cool. Hopefully they'll make it more than that in the future, but that was at least something nice that they added into this bill. Anybody else have any other questions about what we talked about so far before I change topics? Well, then clearly it's time for a cheers, because I got a little tickle in my throat. So cheers. Oh, Mom's got a drink too. I love you. There's our music. All right, cool. I'm loving our little musical breaks. Okay, expenses. I'm going to go into just rattling off a bunch of expenses. So if you've got your pen and paper ready, here they come, all right? So all pass-through entities, business owners, independent contractors, we all write off the same thing, okay? The only people who can't write these things off are W-2'd employees. That's another thing that was gutted out of Schedule A. Even though I'm W-2'd with uncommon adornments, I can no longer write off all the things I'm about to tell you about. That's another change that they made in 2018. Thanks, Congress. But everybody else gets to deduct all of these same expenses that I'm going to rattle off here, okay? So, Lindsay says, does the Firefly soundtrack count as Irish tunes? I think a lot of the Firefly soundtrack qualifies. Yeah, for sure. Yeah, Mom says, yeah, she loves that show too. All right.
The song that was just played was from Firefly. Was from, yeah, the episode where Simon and River get kidnapped by the locals.
I love the fact that you know the show well enough to know even what episode that comes from. So
I'm a geek.
Cheers to Lindsay then. All right, so expenses, here we go. I'm gonna rattle a whole bunch of them off. When we travel for a living, our biggest expense out there usually is our vehicle. I always tell everybody, just save everything that has to do with your vehicle. If you travel for work, there's almost nothing that you can't write off that has to do with your vehicle. Obviously, we talked about mileage. We're going to talk about mileage versus actual expenses here in a second. But your mileage you want to keep track of, you can deduct fuel, oil, repairs, maintenance, tires, insurance. You can also write off your loan interest if you're still paying a loan for your vehicle. You can't write off your monthly payments, but you can write off the interest, which you should get a statement at the end of the year for how much interest you paid on that loan. That's where we all kind of like vomit when we get that statement and we see how much interest we're paying all year long, but that's deductible as well. Beyond vehicle, you can write off your business percentage of your phone, especially if you use your phone for Square, ordering supplies, social media for advertising your business, social media for trying to get your next job. If you're running a website off of it, if you're running Etsy, all that sort of stuff is all going to be using your phone these days. It just is. Even if, you know, you're hotspotting your phone over to your laptop, you're using a MiFi unit. If you're paying for an internet connection at a campground you're staying at, or some festivals that are really cool, have internet that they offer, that's all deductible to your business. So all of those expenses. And every time we're talking about expenses, remember receipts. So you need to have receipts for all these things. Postage, especially now that we're shipping a whole lot more stuff out since we've been stuck at home for a year. Postal services, if you're traveling and you have a mail forwarding company, your mail forwarding is deductible. The packaging used to do such things, that's all deductible. While traveling, if you have to have a storage unit, that's deductible. All the insurances, plural, business insurance, health insurance, vehicle insurance, everything that comes out of pocket, that's all deductible. Any sort of licenses or permits that you have to have in order to set up, if your business requires a certain kind of certification, or a certain kind of permit from the health department, like braiders often do in some states, all that's deductible. Tolls, I say this every time, but when I leave Bristol towing my 1-ton diesel dually and my 40-foot fifth wheel and go to the Boston show, it's $150 in tolls one way. So that's fun. So after we made that first trip, we got an iPass, and that cut the tolls by about 2/3. So that was necessary. The iPass, that's all deductible. If you have assets, those are all deductible. Your vehicle is an asset to your business when you use it to travel the country for business purposes. That's an easy peasy asset. But if you buy, generally an asset is anything over $1,000. So obviously if you buy a booth, that's a big asset. But if you buy a tent, like an Underhill tent that these days are upwards of $4,000, that's an asset. People who sometimes at festivals buy like a deck structure, you know, that would be an asset. Computers, if you bought, you know, like musicians, sometimes their equipment, depending on what they play, is a lot more than $1,000. So generally, if it's under $1,000, you're going to take that as a write-off, an actual expense. But if it's over $1,000, it becomes an asset. And what that means is we're going to divide up that write-off over multiple years. So if you have a booth, we might write that off over 15 years. Your vehicle, if it was like a new truck like mine, you might write it off over 7 years. If it's like a small used car, you might write that off over 2 years. So it really depends on what kind of asset it is and how much it costs to depend on how long you're going to write that off. You're also needing to consider not only this tax year, but the next couple of tax years. So you don't want to take a whole bunch of expenses. The first year let me back up a second. The first year you put an asset into business use, you have the option of taking 100% deduction on that year and writing it all off in 1 year. Or you can take a little bit of bonus depreciation, a little extra. But if you know that in 2021, you hope you're going to make more money than in 2020. In 2022, we hope we're going to make more money than 2021. So as we're looking forward, we need to consider that as we make more money in future years, we need more expenses. So we want to make sure that our assets stretch across multiple years so that we're taking them on the years where we need that expense to offset our income. So when you get into thinking about assets, talk to your tax person about what your next couple of years look like so that they can kind of help you make some decisions about what to do. And if you do your own taxes, come to somebody like me who can just give you some advice on, you know, how many years to take this kind of asset or that sort of thing if your program gives you that option. But assets are something that are going to continue to depreciate even when we don't have much income, like in 2020. They're probably going to cause our businesses in 2020 to be in a negative, which sounds scary, but it's not really a negative. What it does is it can roll over into next year, and it basically, your net operating loss is what it's called, is going to create an expense for you for next year, which is not a bad thing, especially if we end up making, you know, more money in the next year. So don't freak out about that. Adrielle is saying, what about trailer payment interest? We're going to talk a little bit more about RVs and trailers in a second, but short answer, yes. Yes. Okay. per diem. Now, per diem is really a cool thing when we're actually moving and traveling for work. Every other year, if you guys know me, if I do your taxes, you know that I'm always talking about per diem. Where's your days? Where's your per diem? You know, per diem is a big write-off. The government gives us a minimum of $55 per day to write off meals when we're traveling more than 50 miles away from our tax home. If you're going from New York, where you live, to the state of Arizona for a fair, they don't expect that you're going to be able to commute back to your home during the weeks. And so they're going to end up giving you per diem for not only the weekend days, but if you make your own product or you're working during the week doing inventory, maintaining, hard word, your booth or making product or whatever, as long as you're doing business on those days, you can take that per diem. I think most of us know that that whole we only work 2 days a week thing is a complete myth. So some of those days we're just at home doing work on our computer, but that's still work. So you can take a minimum $55 per day. That per diem is 50% deductible though, okay? So there's a line on your tax return that says meals 50%, that's where that goes. So you only get 50% of that deduction, but you get that on every Schedule C. So if you have multiple Schedule Cs, what you need to think about is, why was I in that state? So if you had, again, let's go back to our friend who has 3 different businesses. If she's contracted at this particular fair as a musician, she's going to take that state's per diem on her musician Schedule C. If she actually does 2 jobs at that festival, she's going to take that per diem on the one that makes the most money and needs the most exemptions. Or expenses, I'm sorry. And so you're going to want to allocate your per diem if you do multiple things in the same fair, if you have multiple businesses in the same fair. You can't take the per diem for like 2 businesses at the same time because you're not 2 humans. So you've got to kind of divvy that up a little bit and consider which one needs more deduction. Now, they just changed something in, again, pandemic law changes. They just changed something for meals. So right now, everything we're talking about is the 2020 tax year, but we're in 2021, all right? So in 2021 and 2022, they've brought back 100% meal deduction. That does not count for 2020. That's 2021, 2022. So starting now. Keep receipts, again, for per diem. You don't need receipts because how do you can't have a receipt for per diem. Your fuel shows that you traveled. Your camping shows that you arrived, your Faire pass shows that you arrived. That all justifies the per diem. But if you're going to write off actual meals with this new law, you need actual receipts for these things. If you keep them both, then you can kind of determine, the software will help you determine if it's better to take the per diem or to take the actual meals. So it's going to be like mileage versus actual expenses. If you keep them both, then the software will choose the best option for you, and you can change the option year to year. But the restaurant industry was hit so hard with this pandemic. They passed this new thing trying to help them. And so 100% of meals are now going to be deductible. Now meals, you know, I don't know about you guys, but we're not really like running out to restaurants and eating out like we used to. So meals are not only going to be in restaurants, but they consider takeout to qualify for this, and also delivery of meals. Now they are calling it prepared meals. So it's not going to be like an Instacart order of groceries. Like, that doesn't count. It needs to be a prepared meal that you got from, you know, your favorite restaurant down the road. So, but all those things qualify. So if you're like me and you're door dashing everything because you have too much work and you're going to eat through dinner once again and keep working, you know, I pay $9.99 a month to DoorDash for like not having delivery fees and stuff like that. So now my $9.99 a month is deductible too. Cool. So I'm keeping track of all that stuff. And in the DoorDash app, it's all itemized. So if I ever get audited, like, it's all in there. You know, I've got a receipt for everything. I don't have to keep a paper. It's all in the digital app. Again, more pros for these apps, you know. So that's something to keep in mind. Speaking of subscription services, I don't know about you guys, but especially in the pandemic, I think I'm subscribed to everything that exists in this world. So I write off my Pandora and my Spotify because, you know, they're not the same. And I clearly have to have 2 music subscription programs, duh. But when I'm working, I listen to music all the time. So I write that off, you know. I write off my Netflix and my Hulu and my Prime and my Stars and my all these things. Because again, while I'm working, you know, I'm watching all these things. They're helping me be productive. So I write off all of those things. So keep those things in mind as well. We have entertainers who write off their gym memberships. I feel like that's a little borderline for me personally. I feel like if we own booths or run booths or manage booths or whatever, that we're all also kind of entertainers. But I feel like if your job description on your Schedule C is like actor, you know, performer, that they kind of would understand that there are some things that come with that, like hair and makeup and gym memberships. And so I think that's less borderline to actors and stuff like that than to most of us. So, but that is an expense that I do see often. We also have, let me see, I did that. Oh yeah, like your camping, your travel, all of that sort of stuff. If you pay camping, the nights that you're traveling to a new place, if you have a hotel that you get when you get there, unless you're an entertainer who has it in your contract, the rest of us pay camping usually. If you have hotels, if you have flights, buses, if you have to get to work by boat, like if you do, how cool is that? But all of those kind of like travel things, those are all deductible. They're all required for us to do what we do for a living. So keep track of all of that stuff. If you're a business owner and you compensate your people for things like camping and travel and stuff like that, that becomes your deductible expense. So keep that in mind too. I was just talking about how the Schedule A got rid of W-2 employees like myself being able to write off all these expenses I just named. But my company, Uncommon Adornments, saw this coming, and they're cool enough where they as a corporation are still able to deduct all that. So they came in and started paying all of us back and reimbursing us for our camping, for our mileage, for all these sorts of things, because we can no longer deduct them, but they still can. So as an employer, keep that in mind. If you want to offer some perks to the job, that's all tax deductible to you. And if you need more expenses, that's a great way to show people that you appreciate them, is to pay for some of their expenses out on the road. So keep that in mind. Does anybody have any questions about expenses before I go into a quick mileage versus actual expenses on vehicle? So if it's about vehicle, hold off for a second. Anybody have any questions?
Okay. Hi,
Hi.
Andrea. So especially with living at home so much, I guess that's where I've had a tricky part, because I'm very fortunate to have a house. With, you know, I use my square foot for my house, but then also I'm doing per diems when I'm gone. So with being home, is there kind of a way I can say, hey, no, I really am home way more. I really am using more of my house. Like, can I say, like,
You mean for like a home office deduction?
yeah.
I mean, yes, the thing about a home office deduction is you've got to have a dedicated space.
Mhm.
So if you're using more of your home, then all you're doing is just doing a different calculation of the square footage that you're using for that. And I mean, if you got audited, I'm sure you could very easily explain, yeah, during the pandemic, my entire business moved home, you know, and I had to use more of it. I think that would be normal for a lot of businesses, frankly.
Perfect. Thank you.
Cool. You're welcome. Any other questions on this topic? I'm looking. I see Elise's hand. Go, Elise.
Okay, so one of the things that I have been kind of wondering about with the difference between having only issued 1099s up to this point and looking at going ahead and navigating if I were to be switching to W-2s. So everybody who's been working with us up until this point could write off their costuming and could write off their travel expenses. So if I wanted to, can go ahead and say, hey, I'm going to give you a costume budget of this much, and then write that off. or go ahead and say, hey, I can pay you for your miles. You traveled this far. I mean, it really stinks for them because like per diems, it's not like I could ever compensate anybody like the way a per diem does.
No, it's absolutely true. This is tricky because there are pros and cons to 1099 versus W-2. But if you're going to switch them to a W-2, if they don't do their taxes already, then they probably don't care and didn't know they could write this stuff off. If they do their taxes and they're aware, that is another conversation you need to have with them, which is, if I switch you to this, you're going to have a lot more benefits like unemployment insurance and workers' comp, and I'm going to pay your camping, and I'm going to pay your mileage, and you list all the things, because that means that you can no longer write those things off. And you really just kind of have to balance and figure out what's going to be worth it for them. You may need to start paying them a little bit more because they're going to have taxes withheld. Like it's a whole big thing. It really is. It kind of sucked for me on the first year. It made my taxes really easy because I couldn't write anything off. But it kind of sucked on the first year, but I kind of had to like raise my amount of money that they were taking out each week. But then I get a refund every year. So that's kind of cool. And I don't owe taxes. It's like 50-50 as far as the benefits and stuff goes. But the real thing is, and we talked about this in the booth owner seminar last week, if they're working in your booth and you can tell them when to come to work and what to wear and when to leave and when they get to take a break, they technically should be W-2. That's the legal side behind things. So at some point, you just have to decide as a business owner, I want to do this right. I don't want to get in trouble with the government. So how can I make this not suck for my worker?
And I was thinking about this because if you're a hairdresser, right, because we were making the comparison between like henna painters, which are kind of comparable. Obviously, if you're a hairdresser and you have a shift, you do still have to show up. Mm-hmm. I don't really give much direction to anybody who's ever sold for us. I want them to do it their way. I want them, other than showing up, I let them wear the costuming they're going to be comfortable in as long as it follows the rule book. I mean, there is that, right?
Which isn't your rules. That's the Faire's rules. Right.
Yeah, exactly. It's the Faire's rules. But I want people to use their language. I want them to feel comfortable. Everybody's going to maximize their hustle when they use their own way. So I've had, as far as that goes, I go, well, what's the difference really? And I want to follow the law. That's why I've been given 1099s all along. And encouraging people to do taxes and telling them there's so many good reasons to file. Yeah. But I just go, well, a hairdresser still has to show up at whatever hour and leave at whatever hour. They don't get to be like, well, I'm going to just work a half an hour. They have to be there.
Well, and I mean, in some regard, it is slightly different because they're like, we were discussing, like if they work for a salon where they rent a chair, just like with a henna artist, like Adrielle was saying, she has people who paint for her who really just rent a chair. They don't actually work for her. They're their own business. That is a little bit different because if one of them just decided not to come to work, like Adrielle can't fire them. Like they don't work for her, but she can decide not to contract them further. If they don't show up, Adrielle's not going to get her booth taken from her because no one showed up. She showed up, so it's a little bit different with that. There's also all these rules about hiring and firing and things you have to do when you're W-2 people. But I think a lot of people in what we do for a living have 1099 people because I think it is very, very borderline what we do, because the what to wear to work, the when to be to work, the when we can go home, that is very dictated by the Faire's rules. I think where we get into some trouble is if the Faire opens at 10, but I want them to be there at 8:30 to shine jewelry. Now I've just made a rule for them. And if I'm the one that tells them, okay, the joust is on, you may go eat your food now. Now we've crossed into employee lines.
I guess I'm really weird because I don't do that either.
You're just a great boss.
I just am like, eat when you want to eat, when you're hungry. The rule says you can't do it in front. So please, you got to go backstage if you're going to do it. Flag me, let me know you're going to eat. Right. And I don't want people to come in coming in at work at 8:30 at a fair day. I hate it. Why would I want them to do it?
Me too. We all hate it. Yeah, I know. And it's super, it really is, it's super borderline. I feel like the way the IRS reads right now, depending on how you run your business, you can you'll have to make that decision on your own. It sounds like you may very well still be able to keep them 1099. I guess my real thing is do one or the other. Like keep them on paper, do something. Because even if you can say to the IRS, I didn't know, I thought that I was doing everything, by the rules, at least you're doing something. If you're doing nothing, now you're really in trouble.
Never. I've been getting them since I was in the 90s. My first boss at the fair, Manny Lieberman, he gave me 1099s.
Wow. That's saying something for back then.
Yeah.
Okay. All right. So does anybody have any other questions on that topic or any of the other topics before I move into actual versus mileage for our vehicles? Looking for more unmuting and more questions. Okay. I'm going to run through this real quick. We talked about this extensively last week in the Performer Show. So again, Life's Affairs YouTube channel has that if you want to go watch it. A lot of people use just straight mileage, especially if they're coming to me from like some other accountant. Mileage is easy, it's quick, it's kind of the cheater way. And if you travel full time for a living like most of us do, you're almost never gonna get a better write-off by doing mileage only versus actual. And the reason why is all it takes is one tire year, one transmission year, and that mileage is nothing in a write-off. The other thing is depreciation. If you have a newish vehicle, you can only depreciate it for the first handful of years, but you can't take depreciation if you don't do actual expenses. So if you're only doing mileage, you're really cutting out a major expense for your business. So I don't like it. I don't like it ever. If you have a baby little car and you only do like one local show or something, fine. But if you're on the road full time, and especially if you drive big ass vehicles around this country like most of us do, actual expenses, please, for the love of God, are always the way to go. You can write off everything that has to do with your vehicle. But I will have to say that if you do actual expenses, you also have to keep track of your miles. You have to do both. The software programs will choose what's best for you in every year, and it can change. If the first year you have a vehicle, that's a business vehicle for you for the first time, doesn't matter if it's new or if it's used. They call it putting it into business. So you get this new vehicle, it's new to you or it's brand new, and you start it working for your business. If that year you use mileage, standard mileage, you can flip-flop back and forth every year from standard to actual. But if on year one you use actual, you have to stick with actual forever, because now you've established this depreciation and you've got to keep it going. I've never even considered mileage. All 23 years I've been on the road, I've done actual expenses. So that's never a consideration for me whatsoever. So I'm always going to encourage you to keep both things. When you keep track of your mileage, what it does is it creates what they call a business percentage. So let's just say your business miles, when you calculate at the end of the year, maybe your app tracker tells you about this. Let's just say your business miles are 75% of your total miles that you drive. That creates a business percentage of 75%. Then if you use your actual expense method, what that means is you can deduct 75% of all of your actual expenses. Now next year, it may change, and like in 2020, we're seeing this all the time. People are using their vehicles instead of 75 or 90% for business. All of a sudden in 2020, it turned into 10% for business because none of us were doing anything. We weren't traveling the country, and that makes total sense. But so it can fluctuate every year. Your business percentage may change, but that's okay. That just means that each year you're going to get to write off a certain percentage of your actual expenses. So even if you choose to do the actual method, you still must keep track of mileage. I have a thing that I do every January 1st. I have that manila folder that I told you about that has all my receipts in it, and it says 2020 on the front. So January 1st of 2020, I went out to my truck where I keep one, and I have one in my filing cabinet, and I wrote the end of the year odometer reading on that 2020 or 2019 envelope. And then I put a new envelope in the truck and in my filing cabinet that said 2020. And I put that same odometer, which is my beginning of the year odometer reading, on the 2020 envelope. So every year on January 1st, I put an ending odometer reading and a beginning odometer reading on the year that goes with what we're doing, coming out of one year, going into another year. So that's my little system that I do to make sure that I'm keeping track of my odometer reading. But that's super crucial. And you can guess at your miles. If you didn't keep track of it, you can use Google, you know, to like Google Maps to figure it out or something. But you're always going to shortchange yourself because you're never going to remember all those trips into the town to get stuff from Home Depot and Hobby Lobby and whatever. Like you're not gonna. So it's better to keep track of all those things, at least if you have a starting mile and an ending mile, starting odometer, ending odometer. At least you can see, oof, geez, I drove 20,000 miles this year. I would have guessed it's only 12. You know, at least you can get yourself in a ballpark, but, you know, help yourself along, because a year later, like, what are we supposed to remember? Very little. So keep that in mind. I did that, and I talked about that, and I talked about that. We talked about business percentage, though. I said too early about the apps, because there's where I was talking about the apps in here too. So that's mileage versus actual. Does anybody have any questions about mileage versus actual expenses? Other than Brande said to do actual, so that's what I'm going to do. Okay, I promise I'm always going to tell you the best hot tips, you know? Okay, cool. So we're going to call this a brief intermission. We're going to have a little 2-minute break, get a new beverage, do a jig. Cheers, let's have some music. Let's dance and take a quick break. Shake it off. You're dancing. You dance? No? No dancing?
Beautiful, great job.
Made me giggle.
Randy, you forgot the pro tip of setting the beard down before you start shaking.
No, that's how you know you're a pro. Fine. Oh my goodness. The first time I went to Ireland, we went to oh God, it's my favorite pub in Ireland. I can't remember now. Downstairs they did traditional music, like where everybody sat around a table and stuff, and then upstairs late at night until like 4 a.m. they had everybody up there, and they were like the younger folk, I guess, but they had live bands, and it was still traditional music. But we were old for that crew back then. But anyway, upstairs was their late night thing. It was still traditional music, but it was more like raucous and dancing and stuff. We were laughing so hard. I've never seen something so cool in my whole life. But everybody was on this like dance floor, and we were kind of sitting around it, and they're all dancing, having a good time. And they've all got their drinks, because you don't want to put that down. And they're all dancing, having a great time. And this girl who had already bought us a round of drinks was so wasted. She fell on the ground with her drink in her hand, glass shatters, drink goes everywhere. And like some sort of amazing theater production, all of a sudden 4 men come in from all sides of her. 2 of them pick her up by her arms, stand her up. Another one picks up her glass. Another one hands her a new beverage, and they go right back to dancing again. And I was like, it would never happen in America. You would be booted out of that bar. But she just went back, and it just made me laugh so hard.
Awesome.
Boy, anyway, okay, welcome back from the break. All right, good. We don't have much more to go, but I figured we could all use a break to dance and be silly on St. Patrick's Day and get a refresher. Okay. All All right, RVers. So let's go back into that real quick. So this is something that I need everybody to understand. There's a fine line here when it comes to trailers and RVers and being on the road and stuff. A full-time RVer cannot write off your RV. That's where you live. That's full-time. And furthermore, if you live full-time in an RV, you cannot expense any travel expenses because you're technically always home. A part-time RVer can write off the business percentage, as we talked about, of your RV interest loans, your expenses, your insurance, registration, tires, all that sort of stuff, if you're a part-time RVer. So when you're traveling in it away from your tax home, you notice I'm air quoting tax home all the time because sometimes your tax home is your forwarding company because you need them to forward your mail while you're on the road. And sometimes maybe that's the only home you have. So less is more. When it comes to this, don't talk the IRS into considering you a full-timer and disallowing all your travel expenses. I like to always remind people that you want to use terms like trailer repair and trailer tires and trailer insurance. Those are things that I think are going to help you not get booted if they ever look at that sort of thing. And I know many people who have been through the audit system have not had any sort of issues with their trailers on their taxes. I see what you're saying, Roma, about trying to get an EIN number on irs.gov. irs.gov, I guarantee you, is crashing today because of everybody looking for their stimulus payments. I would wait a couple days and then go to irs.gov to try and get an EIN number. Okay. Home office and rental income. Home office and rental kind of can use the same sort of deductions, but one of them takes in income and one of them doesn't. So if you have a home office, that gets written off on your Schedule C. You need to be super important. You need be super important, guys. You need to be super careful that you're making sure that you're using a dedicated workspace. There's no real way to do a home office deduction in an RV, so like don't even try it. You have to have a dedicated workspace. It can't be like I've spent 9 months sitting my butt on that couch in there doing taxes and doing RC stuff and all this sort of stuff, but that's not my home office because I also sit there and watch movies and surf Facebook, so I can't use that. But if you have a dedicated space like Andrea was talking about, the way you do that is square footage, total square footage of your home versus square footage of your workspace. That can also be storage space, PS. If you keep all your stuff for your business stored in a portion of your garage, maybe you've got so much of your crap in there, you can't even get your car in there anymore. So now that's like a full deduction for your business. I've had somebody who had to build a storage unit on their property for their stuff. That brand new unit, all of those supplies, that's all deductible to their business. You can then write off your business portion, your business percentage again. So my big fat cat jumped on the table and shook everything. She's put on a little pandemic weight like the rest of us. It's fine. But you're going to establish a business percentage again, just like we talked about with your mileage. So your percentage of your home versus percentage of your total square footage of your entire home versus your square footage of your home office creates a business percentage. Then you can take the business percentage of your deductions of your mortgage payments, your utilities. If you had to get a plumber out there because you had some sort of water break, you have to use a bathroom while you're working, I'm going to guess. So it's important to repair that water. So your business percentage of all those things are now deductible. So that becomes a big, big expense if you have an actual dedicated workspace. Now, if you have an actual room in your house that you're renting, maybe when you're out on the road, a lot of people do this. When you're out on the road, they'll rent their house, maybe entire house, Airbnb. Maybe they'll rent just a room. Maybe they rent a room full time. Maybe they rent the basement, the entire thing's, outfitted as an apartment. That now becomes rental income. And now we're talking about serious deductions. Your rental income would get reported on a Schedule E, which is just like a Schedule C, except a fun new letter. And so you would deduct all your expenses over there on the Schedule E, and it's all the same type of expenses. But like if you need to upgrade, if you need to put in all new furniture in there because you're going to Airbnb it, that's all deductible. If you needed to get all new sheets, you had to buy a new mattress, like that's all deductible under rental income, where it wouldn't be for a home office. So that's something to consider, and that's a major, renting is a major business. So if you have the opportunity to do that, I know somebody who, when they're home, they live in their house and they rent out their Airstream. Like, hello, that's just thinking, you know, that's real smart. And that's a great side business, you know. The PPP and all that stuff that we're seeing the benefits of right now is Schedule C people. Schedule E people are also qualify for all that stuff. So that's just another business tip. Adrielle is saying, what about a carport for trailer storage? You meant like you want to buy a carport and put your trailer under it when you're not traveling? Yeah, sure. Heck yeah. All that stuff. She's like, Eric, we can do it. Yeah. Brande gave us permission. Hey, Eric. All right, cool. Anybody have any questions about home office or rental income? I'm going to move into state income taxes and then audit defense and stuff like that. Questions on what I just talked about? Rolling through, looking for hands, looking for unmuting. Okay, cool. State income taxes. So we're not talking about sales tax here. We're talking about income tax, okay? Here's a cheers to traveling for a living and having to file in multiple states. Thank you. All right. Thank you. Andrew's like, damn it, I missed a cue. All right. So you're legally required to file income taxes in every state in which you earn income. I'm going to say that again. Where you earn that income is where you have to file an income tax return. There are very few exceptions to this. Each state has an income level that you have to file if you earn more than that amount of money in your income. You have to do your federal tax return, get all your expenses in there and get down to your net income. And then that net income is when you start Googling to find out what each state requires. Wisconsin requires like $2,000. So you have to earn $2,000 in the state of Wisconsin net expenses, and then you're required to file a non-resident tax return. The state of Pennsylvania is my favorite one, $33. $33, and you have to file a non-resident tax return in the state of Pennsylvania. Somebody was on here, one of our other calls, we were just having a Pennsylvania bashing party, but they do stuff all crazy. So $33, and they change these every year. So you have to check it every year. I keep a spreadsheet every year of all these stupid rule changes. Make sure that you're Googling the name of the state, Pennsylvania, non-resident income filing requirement. Pennsylvania, non-resident income filing requirement. Change the state for every state that you need, but you got to do that every year. So every year, I probably do 40 different states for everybody. So I have to go Google that for every single year and see who's decided to do something dumb and change their requirements. Sometimes you don't have to pay if your state's reciprocal, so we'll use Pennsylvania again. If you're an Ohio resident and you earn income in Pennsylvania, they're reciprocal, so you would just claim to Ohio your income earned in Pennsylvania, and then those two states like figure it out. So those are some of the reasons why you may not have to file in the states, but I also want to talk to you people who purposely put your home addresses in Texas and Florida or Tennessee or wherever, because you put them there more than likely because there's no state tax there. But guess what? It doesn't mean that if you do a show in Arizona that you don't have to pay the state of Arizona on the amount of income that you earned in Arizona. Okay, so you do still have to do that. There's so many people who come to me with previous accountants who have never filed state tax returns because they live in Florida and they do all these shows out of the state. And I'm like, that feels like a way to get your license taken from you as an accountant or a CPA if you don't know you're supposed to be filing there. That makes me super nervous. If you are only paying your home state, which a lot of people do incorrectly as well, at least if you're paying your home state, if Arizona catches you, you can go, my bad, I didn't know I was supposed to pay you. And then you go amend your home state return, take some of that money back and pay Arizona. But if you're a Florida person or a Texas person, you've been paying nobody. Well, now you're just in a lot of trouble because now you got to come up with all this money. So just keep in mind that you do have to pay income tax. Now, you don't pay income tax on all your income to every state. You pay Arizona based on what you earned in Arizona. You pay Maryland based on what you earned in Maryland. So it's an allocation of state income. And you don't have to allocate expenses either. That all the expenses came out before we even started dealing with the states. So when we deal with the states, we're dealing with net income, and that's after your expenses. So you never have to differentiate your state expenses except if you're paying sales tax. If you're paying sales tax, that obviously you need to allocate to the state. Anybody have, oh, one more thing I want to say about this. I get people all the time who get confused and they think like if they got a W-2 or a 1099 that they have to file in the state in which the person who issued that to them is based out of. No. If your employer is based out of Minnesota and you never step foot in that state, you do not file in Minnesota. It doesn't matter where they're from. Anybody have any questions on state income tax? This is one of those things too, if you haven't been doing it, start now. Business owners, you have an added risk to not allocating and paying state income tax, because if you're already paying them sales tax and they figure out that no one's paying income tax on whatever sales were earned there, like how did you make those sales there? Is it magic? Somebody has earned income in that state. And I will say that I know specifically of a Faire who had the state board come into the Faire and subpoena their pass list, because everybody who technically has a pass supposedly earned income there, right? And then all of a sudden, all those people are getting heard from the state as far as income taxes and why they're not paying them. It was a big to-do when that happened. So, they're kind of on to us, you know. Elise, I see your hand up. Do it.
Okay, so I just today filed my sales tax for Arizona, 0 gross. For income tax this year, are we going to have to file 0 for states we didn't do business in, or it's just a skip, we don't bother?
Okay, so here's the thing. Theoretically, no, we don't file those things, but there is a chance that those states will come back to you. I talked about this on the last call. We just got a letter from the state of Ohio with a bill of taxes that we owe to Ohio. Well, that show canceled last year, and it's a 1 weekend show where we have a temporary permit. We didn't even get the temporary permit because it canceled for this year, but they sent us a bill of what they think we owe. So now we've got to go.
For income tax, not for sales tax.
Yeah. And so now we have to go do a 0. So theoretically, no, but like in Ohio, I was an Ohio resident for a long time before I changed my residency to Arizona. After a few years, Ohio sent me a letter and they sent me a bill. And they were like, based on the last time you filed, we think you owe us blah, blah, blah for what tax year. Well, I stopped doing the Ohio Faire. So even though I was still a resident there, I never made any money there. So then I had to do an Ohio 0 return and write them a letter and explain that I don't earn any money in the state of Ohio anymore. That put a stop to it. That happened to me in Wisconsin many years ago too, by the way. That put a stop to it. But they absolutely came at me. In Wisconsin, it was my business. And in Ohio, it was my personal. So you may get a letter where you've got to go back and produce a 0. The state sales tax will charge you, and you will owe them money and penalties and fines and stuff. So that's different. So you've got to go do a 0.
Yeah, well, I've been doing that for all the states, but for the sales tax. But I was just wondering, and I mean, I personally, I'd rather go ahead and file 0 for all those states and say, hi, I was here, but not here. Like,
Right.
yes, I'm comfortable with that.
So what I've been doing for most people is producing the 0s, but they won't, some of the states won't let you file them. So
Okay.
I know. So I've been producing them and I've been sending them to everybody. And if you get a letter, what you're going to be required to do is print that and mail it, but you're already going to have it. So I've been doing that for people for a lot of their states. That's really rare to have happen, what's happened to us, but now it's happened to me twice and it's happened to him once. So I guess it's not that rare, but in 23 years, you know, but yes. And if I do your taxes and you're like, please just do the zeros, just tell me and I'll do them. It's fine.
Thanks. Yeah, it's Pennsylvania I'd really be worried about because they are just so weird.
Me too. Okay. I think that's a good idea. All right, cool. Does anybody have any questions on said topic? All right, cool. Let's see. We talked about state income tax. I think that's good. Business owners, real quick. Quarterly payments. I get asked this all the time, and we didn't talk about this last week. I totally forgot. People ask me all the time if they should be paying quarterly. Here's how you make the decision. At tax time, if you owe so much money that it hurts, it's time to start paying quarterly. If you set that money aside, it doesn't hurt, and you know it's coming every year and you handle it and it's fine, then you don't need to. You don't have to pay quarterly ever. It's not a thing as long as you do your taxes on time and you pay your tax bill on time. You don't get penalties or anything like that. It's not a huge deal. So that's quarterly payments. Most people don't pay quarterly payments. You need to have a pretty rockin' business to pay quarterly payments. If you owe $8,000 every year and it just sucks every April or October or whatever, it may be time to start thinking about quarterly payments. And all that is a savings program. Basically, you're paying the government every quarter for next year. So when you get into next year, they say you owe $8,000 and you go, nuh-uh, because I paid $8,000 already, and then you owe nothing. But getting started in the first year kind of hurts because you have to pay this year's tax bill and you have to prepay for next year's tax bill. So it's a little ouchy. But it's kind of one of those things where, like, do you want them to take out money out of your W-2 so you get a big refund, or do you want the money every week because you need to pay your bills? It's a personal decision, but it's not required. All right, audit defense. Okay, so I'm gonna just cheers now ×2 for audits. Let's talk about that for a little second. All right. Thank you. Okay, so the IRS technically can audit you for the last 3 years. But if they find anything wrong with what you've done and you owe them more money, they are now allowed to go back any year they want. Okay, so it's very important for you to keep at least the last 7 years, which is kind of what everybody usually hears, you know, keep the last 7 years for an audit. They say that because they can go back further than that if they make any changes. It's a good idea to keep that. I keep 7 years with me on the road. I keep the rest in my mom's storage unit just in case. And so, but now with the advent of digital files and stuff, if you can start moving all those old years into digital files, even uploading them to the cloud, like that's a really good idea. Upload them to the drive, Dropbox, wherever you keep your stuff. Then you can get rid of all that paper and not have to travel around with it and stuff. So I've slowly but surely been kind of transitioning over to all digital. But that's just an FYI to that. Getting audited is terrifying the first time, but as long as you're saving all your receipts, it's fine. You're gonna answer what they want. Usually it's about your expenses. You're gonna send them in 752 pages covered in receipts, and they're just gonna be like, stop it, go away, you're fine, leave me alone. That happens to me like all the time. I've personally been audited like 3 times because having expenses as an employee, they think is really rare. So they love to look at my taxes, but then I send them all these receipts and they're just like, stop it. So as long as you're saving everything, you're fine. You get audited, you prove that you know what you're doing. You have all this proof of expenses and receipts and you're fine. The IRS is actually, they're fine. The auditors are usually pretty damn nice. I've had an auditor talk to me for 45 minutes, getting everything right for me in the past. So they're really, it's not as bad as people make it out to be. The scary people are the states. Like, don't get in trouble with the states. The IRS are fine. It takes some time to make all these photographs and stuff like that, but It's really not that big of a deal. Just make sure that you're keeping track of all your receipts, okay? And then I think that's actually the last thing that I have to discuss today. So I want to open the floor to you guys and see if you have any questions. I'm going to start with Elise's question over here in the chat. The deadline to file $0 gross sales for February in Arizona is approaching for all who sell there, by the way. We touched on this just a second. So let me just say real quick, if you didn't open a festival in 2020 that you usually open, you need to go file a $0 sales tax return. If you normally file sales tax, they don't understand that we didn't open, so you have to tell them. So you need to go file a 0. In Arizona, we file one for February and one for March, and you can't file till the month's over. So we have to file 2 zeros in Arizona, depending on how you're set up in North Carolina. North Carolina is super fun because they make you, as a rule, file a 0 for the 10 months that the festival is never open, let alone the 2 we didn't open this past year. Like, it's just stupid. So every state's different. Some make you file sales tax annually, some it's quarterly, some it's monthly. Like, it's just ridiculous. So you've got to be careful to check those rules. And just as a reminder, if you normally file sales tax somewhere for 2020, you need to go back and file that 0. Because they will send you a bill and they'll just make up some number. And then you go file your 0, and then they're going to charge you a penalty for late filing. So it's super fun. So just a reminder, as Elise is just saying, because Arizona did cancel for 2021, so the February 0 sales tax is due now. So thanks for that hot tip. Okay, I'm opening the floor for anybody else who has questions on anything we've discussed or anything that we haven't discussed. And I just want to remind people, if your question is too sensitive or you'd rather not say it in front of the group, PM me after. I'm going to put my contact info up on the screen here in a second. But if you want to ask it right now, go for it. Floor is open. I'm looking for unmuting or hands raised. Everybody's saying like, cool, we're good. I talked enough? Okay, good. All right, cool. Let me go in here real quick, and I want to show you my contact info so that if you do have questions that we did not address during this, that you can reach me after the fact. You can reach me on Facebook PM. That's always going to get to me first because my phone's glued to my person. Email, as I have warned everyone, I check between midnight and 4 a.m. when everyone else is asleep. So if you don't need an urgent question answered, you can get me there. You can also text me. If you call me, I'm probably not going to answer it because I'm probably doing something like this and can't answer the phone. So that's how you reach me if you have a question that we didn't cover, or if you forgot something, or you, as soon as we're done, you're like, damn it, I should have asked her this. Send me a PM and we'll walk through this. Once again, all of this from the past 4 seminars are up on Life's Affairs YouTube channel. Also, every Saturday we're doing a replay. So if someone you know needed to be here tonight and couldn't be here, every Saturday at 2 p.m. Eastern Standard Time, we're doing the replay on YouTube and Facebook. That'll be up on my page, on Life's Affair, on the RC page. I'm not live, obviously, talking to people, but I am answering questions in the chat. So if somebody needed to be there, give them that link and tell them to come over there. And I think that's everything that I have for today. So guys, thanks for wanting all the knowledge, especially those of you who've been to like every single seminar. That's amazing. You're like my favorite pupils. And thanks for being the Ravenclaws again. And happy St. Patty's Day to everybody this way. Cheers to all of you. Have a great night. And thanks for coming today. Thanks to Life's Affair and RC for making this happen. Cheers, everybody. Good night.
Dancing was the best.